In this recording, I will be going over some liabilities discussion questions. Now recall that liabilities are obligations, and under liabilities we do have current liabilities, which are liabilities that are expected to be due in 1 year. Examples are accounts payable. Various expenses that have not been paid, like salaries expense becomes salaries payable, wages expense become wages payable, rent expense not paid, rent payable, utilities payable. These are all examples of liabilities that will typically be current liabilities. We may also have short-term debt. And then under long-term or non-current liabilities, which would mature in more than 1 year, typically, we have long-term notes payable, bank loan payable, bonds payable. These are all examples of non-current or long-term liabilities. So let's start off with Wild Incorporated, which receives a bill from Eastern for $20,000. Eastern has credit terms of 2/15 net 45. If Wild takes advantage of the discount, how much cash do they pay Eastern? So Wild has an obligation to make payment to Eastern, and the credit terms, let's assume Eastern is a supplier. So Wild has an accounts payable, and the terms are 2/15 net 45. Well, the meaning is 2% discount if payment is made within 15 days. And Wild Company has 45 days to pay. Now, if Wild takes advantage of the discount and pays within 15 days, then the amount paid will be 20,000 minus the discount, which is 2%. So 2% of 20,000 is 400. Subtract that from 20,000, we get 19,600, which is the amount paid to the supplier. Now note that when this payment is made, cash will decline, and let's assume it's an accounts payable, which is a liability. The accounts payable will decline also. So the accounting equation will be balanced. Assets go down by 19,600. Liabilities also go down 19,600. Now, Porters issued a 120-day note in the amount of 180,000 on December 14, 2012, with an annual rate of 10%. What amount of interest has accrued as of December 31, 2012? Now let's recall our discussion on accrual accounting, where we accrue or recognize expenses, not necessarily when cash is paid, but as long as the expense has been incurred. Now, Porters issued a 120-day note. Now, once it issues this note in exchange for 180,000, it means that it is borrowing 180,000, and the lender now has that note, which is a contractual obligation that binds Porters to make payment plus interest. Now, interest accrues as the days go by. So even though payment has not been made, the company must accrue any interest incurred. So the borrowing occurred on December 14th, and at the end of the year, the company is closing its books. Financial statements must reliably reflect all expenses incurred. So we need to recognize the interest expense incurred between December 14 and December 31, and it's 17 days. So to calculate this interest, we'll do 17 over 365 days multiplied by the interest rate, which is always quoted per year, multiplied by the amount borrowed, which is 180,000. And we will get 838.36, which is the interest incurred for the 17 days. This must be included in the financial statements for 2012. Note that it is an accrual because cash has not been paid. Now moving on, let's look at long-term liabilities, and we'll focus on bonds. Now, we have a company that reports financial statements each December 31, and it issued 500,000 11% 15-year bonds dated May 1, 2012. Note that once London Incorporated issued the bonds, investors invested in the bonds. So London received cash from the investors in the bonds, implying that the company now owes bondholders. It will have to pay interest semi-annually. Now, the bond issuer issued $500,000 face value bonds. The 11% is the coupon rate, or the stated rate, the rate at which interest is paid. The bonds have a maturity of 15 years, so after 15 years, the bonds mature and the face amount would have to be paid. Interest payments are every 6 months. So 6 months from May 1st is October 31, 6 months April 30th. So every October 31 and April 30th, interest will be paid. And it is based off on 11% divided by 2, because it's semi-annual payment, multiplied by 500,000. So this interest payment will be made every 6 months. So the bond issuer has borrowed funds from all those who invested in the bonds, who purchased the bonds. Now moving on, we are told to assume the bonds were sold at par. If bonds are sold at par, it means that they were sold at face value. If we were told the bonds were sold at a discount, that would have implied it was sold at a price below the face value. For example, $490,000. If we were told the bonds were sold at a premium, implying at a price higher than the face value, for example, $520,000. But the bonds were sold at par. Now we are told to complete the financial statements effects template to reflect the bond issuance. Let's start off with the bond issuance. The bonds were issued at par, so they were sold at 500,000. So the company received 500,000 cash, and it now has a liability, bonds payable, of 500,000, and the accounting equation is balanced. Note that no revenues or expenses have been earned or incurred, so nothing goes on in the income statement. Moving on, the first semi-annual interest payment. How do we calculate this? 11% divided by 2, because payment is every 6 months, multiplied by the face amount, and we get 27,500. Now the 27,500 is cash payment as interest to the bondholders, the investors. So they receive 27,500 in total. So let's start off with the income statement. 27,500 is expense, reduces net income, reduces earned capital. So on the right hand side, earned capital declines by 27,500. On the left hand side, cash reduces by 27,500, and the accounting equation is balanced. Now moving on, in C, we are told to do the financial statements effects template to reflect the retirement of 300,000 of the bonds at 101 on November 1, 2012. Now, let's start off with retirement. Retirement means that those bonds have been repurchased and retired. So those amounts are not owed anymore. The liability has been retired. Now, why would a bond issuer retire some bonds prior to maturity? It is possible that interest rates have declined and the bond issuer wants to refinance. Now, the bonds were retired at 101. Now, bond prices can be quoted as percentages of par, or the face value. So 101 means 101% of the face amount. So if 300,000 of the bonds were retired at a price that is higher than the book value, then we potentially have a loss on retirement. So 101% of 300,000 is 303,000. So that was how much the bond issuer paid to retire the liability, the bonds payable. And the amount of bonds retired was 300,000. So the difference of 3,000 is an overpayment, and it represents a loss to the bond issuer. So let's look at the financial statements effects template. First of all, 303,000 is what was paid in order to pay off the liabilities. And again, please remember that it was a portion of the 500,000 that was paid. And now let's remember that the portion of the liabilities retired was 300,000. So under liabilities, we have to reduce it by 300,000. Under cash assets, payment of 303,000. So the difference of 3,000 is an overpayment and is a loss on retirement. It reduces net income, reduces earned capital, and the accounting equation is balanced. On the left hand side, negative 303,000. On the right hand side, when we combine these two, we have negative 303,000. So this brings us to the end of our analysis of liabilities questions.